Urgent trade alert, January 4th, 2023. Our predictions are coming true. Massive deflation wave incoming. Here's the latest chart that's getting markets super excited today. ISM prices are crashing. This is predicting that we could potentially have the US CPI heading towards zero by the end of the year. Digital assets, tech, and the long bond is what we're predicting get you rich in 2023. And hedge that you're wrong with natural gas and oil. Right now, we like natural gas. There's been some unfortunate things that have crushed our natural gas position in the last few weeks, but our case for being long natural gas and oil long-term remains. And this will be the key hedge to protect your long duration assets, which essentially means we think interest rates are going to fall for the next several years. Buy these 5 stocks now to profit in 2023. We're currently looking at a $50,000 trade alert in our high risk portfolio. This is designed to at least double your money. Last year, we didn't pull that off. The year previously, we tripled your money. And I believe we have the perfect setup with very few changes in this portfolio currently. Per $50,000 with the high risk strategy, you're picking up 656 shares of UVXY. This is the crash insurance play coming in at about 8.6% of the portfolio currently. You would buy 1,608 shares of TMF. That's the 20-year treasury bond times 3. Safest bet on the planet after being down 2 years. This is the biggest crash in the bond market in history. And as long as we're right on inflation falling, this is the safest place to make money. Currently have 1,608 shares of TMF per $50,000 invested. Next, we've switched from ETHE to Coinbase. ETHE has a lot of weird stuff going on it with its parent companies. And until that is resolved, I think we can make more money safer with Coinbase than ETHE. So currently you have 295 shares of Coinbase. And again, this is a company that has essentially a monopoly now in the US for its market. And it has the ability for call options to come in and really explode the price of the upside. Plus 15% of its shares are currently being shorted. So a huge opportunity in coin currently. Next, we're long FNGU. This is all your tech giants like Tesla, Facebook, Amazon, Apple, all down massively over the last year. A huge upside here. Leverage times 3, pick up 262 shares. And then our hedge is in BOIL. This is betting on the cost of natural gas going up. So we had a few things. A big heat wave has come and has driven the price lower. And then in Europe, they also had a heat wave. They put a price cap in, but then they really shut down industry and incentivized low energy use over the winter. Now that prices are down, I do believe the usage is going to ramp up, and I still expect us to sell this in March, hopefully for a large profit. Another cold wave would do a lot to get that position back up. Meanwhile, the oil and gas play NRGU is starting to look more attractive. So again, the primary strategy to hedge our long duration plays, which is TMF, coin, and FNGU, is to be long these rare energy products that have been malinvested and underinvested for the last decade. And as China slowly comes back online, Europe starts using all of its energy. I do believe we're going to see both of those plays very profitable over the long term and a key hedge for any portfolio. Now, again, if we break this down per unit, all of our members follow units of investment. The breakdown is 20 UVXY, 49 TMF, 9 coin, 8 FNGU, and 21 BOIL. Cost per unit comes in at $1,524. And again, if you're on a free trial and just starting out the year with us, the sample trade alerts for $50,000. That's enough exposure to make a lot of money in your 14-day free trial. Now, really quickly, we have a conservative strategy called the Safe Growth. Quick review of its unit per investment. It's actually doing very well this year, up 4% to start the year, and primarily because it has a huge treasury position. On the Safe Growth play, we've made no adjustments in the last few months. We did make one major adjustment to the high risk strategy. Still looking at some potential changes for Safe Growth, but we're going to be really focusing on the CPI next Thursday, which I expect is going to be falling and should be quite beneficial for this portfolio as is. Currently, it is 8 shares UVXY, your crash insurance, 57 shares TMF. So again, this is called the safe growth portfolio. We're putting most of the eggs in the safest, best bet possible, not necessarily the one that'll make you the most money. And that is for sure the treasuries. Now, usually the offensive plays can outperform treasuries 2, 3, 4, 5, even 10 times. So I recognize the two programs are targeting different returns. On the offensive side, we have the S&P 500 times 3 with UPRO with 2 shares. One of our best performing assets this year has been China with Asia exposure with EDC. That's the the EEM ETF times 3, coming in at 6 shares per unit. We've still got the grayscale product, GBTC. Haven't made a move on that yet, 11 shares. If we do make an adjustment, that could quite likely become one of the plays we consider changing. 4 shares of the NASDAQ times 3 with the triple Q, and then 7 shares of BOIL, the natural gas hedge, the inflation hedge. Here's another look at the ISM prices paid, predicting inflation to hit 0% by July of 2023. Not so sure we'll get to that level, but I do expect it to fall for the next year or two. Here's a look at where a lot of the inflation has been stemming from in Europe. And we're looking at the PPI, the producer price index, falling rapidly, which does signal that Europe's inflation has peaked out. If we look at the energy inflation in Europe, it has crashed, but you do need to note that they shut down a majority of their economy to prepare for war with Russia and filled up all their energy to super high levels at extremely high prices. So I do expect this to start to rise again. Food index also falling. And again, the UN food index is being reported much lower than what the euro is. And we're seeing a similar problem with the way our government reports rent inflation compared to what real-time data is. So it's quite easily predictable that the inflation and CPIs globally are going to be falling is the predominant theme this year. Stocks rally during Fed pauses. We're looking for the Fed to pause, perhaps as early as the February 1st meeting. Next Thursday's CPI print will give us a good hint as to that. If not February, I believe they will pause in March. They're still talking a big game, but the bond market's not buying it. Everyone's positioning for falling inflation and a Fed pause. In this chart, you can see when the Fed pauses, you typically get really nice stock market rallies. And the problem with this is that when the Fed does pause, there's trillions of dollars on the sideline that can jump into risk assets and make shareholders feel rich again, which is going to reignite that inflationary impulse to spend lots of money. So that's why we may see the Fed a little bit scared to make the official pause, even though the markets are going to start pricing that in. Here's a look at the average heat. We're at way hotter heats than typical globally. About for the last 2 weeks, for the next 2 weeks, it's anticipated we're going to have hotter than normal temperatures. But again, the general theme is we got China reopening slowly. We've got Europe going to need to turn back on its economy, and energy demand is going to become a problem long-term for global economies. So expect us to be playing BOIL and EnergyU back and forth for the next decade as a critical hedge to protect your long duration plays, which again are bonds, tech stocks, and then the digital currency products we like to invest in. Here's the European inventory actually jumping up a little bit. But again, typically they're going to run this dry down towards April. And so we want to be selling BOIL sometime in March. So I do expect to go back up and hopefully hit that $90 target. Cold weather and turning back on the German economy and the Chinese economy will really help drive those levels down and push those prices back up. Santa Yellen, inflation will be much lower. That's the expectation for this year, and I do think that's correct. How has S&P 500 performed once the Fed hits the pause button? You can see these returns over various periods of time, all except for the dot-com bubble crash. It's been very strong returns when the Fed pauses. Now, pivots typically happen during a crash. So we don't want to pivot where they cut rates. We want to pause. And that's typically when you get these really nice returns. Last CPI, we had the biggest drop in the headline year over year. And I think we're going to have a really good surprise next week as well. One of the reasons we believe this is in this chart, we're comparing the October CPI heat map to the November. In red, you have the hot inflation. In blue, you have the falling inflation. You can see the heat map has almost no red month over month. And primarily where the red is, it's in the shelter component, which we know is looking 6 months into the past when real-time data is crashing. Another good way to predict the inflation is look at the M2 money supply. And this has been falling for about a year and a half now to fight inflation. So again, this is predicting that inflation falls for the next 12 months as well. Now, again, the trick here is if the Fed does pause, these impulses are going to start to switch. That's why they're going to be a little scared to do that. One of the big arguments that we're going to have long-lasting inflation is that there still remains a lot of job openings relative to the labor market. And they're just not able to get all the workers back from the lockdown. In fact, we're still short several million who refuse to go back to work. Now, the argument is that the 5% wage inflation is going to keep inflation at these levels. I would say that this is not true. It's the inflation that's been driving the wages. Once the inflation's falling, people will be much happier with the current labor offerings in the market. Also, it's important to note that the wage gains have not kept up with the inflation rate. As you can see in this chart, since 2021, the increase in cost of goods has outpaced the increase in labor wages. So there's not more money being made to offset the inflation to keep this driving higher. Here's a look at the labor force participation rate. And this does remain a big problem in the US. Most likely, what we're going to see is as people run out of savings, more people are going to be willing to go back to work. And again, a rising labor force would actually be inflationary. We just don't have that currently. Here's a look at the wage gains. That's been pretty much the main case for the bears. I think we're ready for another leg down because all the other data from housing sales to PMIs to ISMs are all crashing quite rapidly. Energy's down, food's down. So you're really just looking at services and wages being a little sticky on the inflationary side. As far as predicting a recession, the economy is still very strong. Consumer spending just hit a new high. We're still importing lots of goods in the US. Retail sales did slow down, but again, still hitting new highs. And the consumer credit is still growing, and banks are reporting the lowest delinquency rate in history on credit. So really not seeing some sort of 2008 credit crisis. Banks are continuing to grow credit, as you can see in this chart, hitting a new high. China is booting back up. Finally, it's happening slowly. They're slowly getting back to a normal regime. It took the U.S. about a year for everybody to get out of the lockdown mode and want to go back out and feel safe. And so I expect China to slowly reopen up this year. And again, that's going to drive a lot of energy consumption. China's exports still healthy. This is our measurement of the global economy, whether or not we're about to see some sort of global recession, not seeing it in the Chinese imports or exports. So that's a quick overview of how we're looking at the markets and the most important data that's come in the last week. We're about to go through charts of each position in detail now. But if you're on a free trial and you want to get a walk through the membership area and customize trade alerts and actually follow our safe growth and our high risk portfolio, call Dean now at 505-322-7515. Okay, let's go through the positions one by one. Buy 9 shares of coin. Again, this is per unit of investment. If you're doing 10 units, you would multiply by 10. We like Coinbase right now for the stock market. And you can see it's up 11% in the last 5 days. But it's down 49% in the last 3 months. And it's down 83% in the last year. It's grown its users by about 10 times, but it's back to the valuation of when it first IPO'd. This is a screaming deal and our favorite exposure for digital currencies. for 2023 in a stock account. Now, if you are a Rebel dividend investor, you're going to make way better returns owning the real assets with leverage. But as far as a stock position we have switched out of ETHE into Coinbase while we see how this fight between three parties essentially involving about $1 billion of capital that's been held is coming to a legal battle that we want to see how that plays out currently. Now, one of the assets we're really bullish on is ETH, and you can see it's up 12,000% over the last, 93,876% since 2016. And that's if you bought and held through 2 crashes now. So we're a long-term fan of this asset. The asset we did get out of, ETHE, is down 40% in the last 3 months. And again, the main reason we're long digital currencies because there's a limited supply of these and governments keep spending more money than they have. The US is pushing through a $1.7 trillion spending bill currently, and they are addicted to debt, and the voter base is addicted to the free goodies from the government. So until that trend changes, this is going to be one of the best assets to invest in long term. This is the US government's deficit projections. And they always underestimate what they're really going to spend. But their plan is to grow the deficit from $1 trillion to $2.3 trillion by 2032. It's really all you need to know to be a long-term bull in digital currencies. Now, based on the Bitcoin halving cycle, as well as the US bond market cycle, we're expecting this asset class to peak out, as well as inflation to hit a low in early 2025. Step 2, buy 21 shares of BOIL, your inflation war hedge. This one's been clobbered since we got in, and even since we added to it, which again was due to the European price cap, Europe shutting down its industries, China's opening being slower than we thought, and then a big heat wave coming in. Long term, I expect all of those to reverse course and for us to still do very well on BOIL. So currently no changes to that position. I know a lot of people weren't happy about that recent drop in it. Now, here's a look at another product that we're interested in rotating in and out of between BOIL to hedge against inflation or malinvestment in energy, and that is NRGU. Getting back towards a price that I like, as I think we're about near the bottom in the sell-off in oil. So we could be adding some exposure to NRGU and even be running BOIL and NRGU simultaneously in the near future. NRGU gives you these big oil and gas companies leverage times 3, which you can see on the screen, like Conoco, Chevron, Marathon, Occidental, and Exxon. Here's the slide in oil. We've got both natural gas, oil falling. It's almost certain the CPI is going to be a really bullish surprise next Thursday. So get excited if you have exposure to Coin, FNGU, or Rebel dividends. That's where I think you're going to see the biggest jump if we get a really nice CPI next Thursday. Skipping through a couple of those charts, just showing you how perfectly priced some of these big oil and gas companies are. We've been waiting for a little sell-off to get back into that play. Okay, next, buy 20 shares of UVXY. This only makes money if you get a super big stock crash, like we did in March of 2020 when the whole globe locked down and crushed the economy. And we had a 25% decline in a month. This went up 1,000%. So right now we've not added to it for quite some time because I do think the inflation's falling and we're at a short-term bottom in the market. Now we could see the Fed pivot, push these markets up extremely high, and then get a new inflation impulse coming in. So that'll be something to be worried about if assets start to go up significantly. So again, here's the VIX UVXY product during that lockdown where it went up 1,000%. The only thing I think would make this happen again would be the inflation comes roaring back and catches the market off guard and then knocks the bond market down once again. But at this point, I see no reason to believe that's the case. This is just comparing 2008 to today with the VIX. And then you can see that huge spike. Again, I don't think that's the case, but we'll be willing to add to that if I'm wrong next Thursday and the CPI is a lot hotter. Next, buy bonds, buy 49 shares of TMF. This is the 20-year Treasury. And again, the bet is that interest rates are going to fall because inflation's falling. And we think this is going to top out around 2025 based on market cycles. Here's your chart of what it's playing, the TLT, leverage times 3. And again, you can see it can have these big pullbacks, but then it rips higher. And that's the only way the government continues to raise money. They need these interest rates to go lower over time to continue growing the debt pile. And unless we think the government's going to reverse that course of growing debt, then we want to be long these bonds when we think inflation's peaked and falling. And that's exactly where we're at today. My expectation is this bull market in bonds will last till approximately 2025. If we look at some of the bond markets associated to the stock market, we're already seeing quite a nice recovery. This is the high yield corporate ETF, and it is up over the last 3 months. This chart, we're looking at the 3-month government bond, and we can see it looks like it's topping out, getting ready to flatten and then crash. Again, that is the trend over the last several decades. If we look at the 2-year, which is highly predictive of what the federal funds rate is going to top out at, you can see it stopped moving up for the last 3 months. It's been trading in a range as high as 4.7, currently at 4.3, which would mean perhaps another 25 basis point rate hike in February and the official pivot come March. Here's a long-term chart on the 10-year, and you can see unless we're going to have a decade or two of inflation, which would most likely be marked by remanufacturing in the US and driving the labor force participation rate up, it's unlikely that we're going to repeat the 60s and 70s. More likely, we're going to see this crash down towards zero due to demographics. Here's the 10-year over the last 3 months. Again, it's been trading flat as well. So the bond market just doesn't believe the Fed's going to keep hiking rates another 100 basis points, which is what some of these speakers have been coming out and saying today and yesterday. Here's the 30-year, same trend, same problem. If the government wants to keep borrowing and growing the deficit, they must manipulate these lower. We're seeing the same in Europe. The Italian bond, which had been racing up, is starting to top out and fall, as you can see in this chart. If we look at some of the inflationary impulses that were really highlighting this move, the lumber futures have crashed from 1,600 down to 387, and down 11% in the last 3 months. Copper futures are being a little sticky here, but definitely down from the highs of about 4.8, currently at 3.7. And again, with China reopening, this one could be pretty sticky for the coming year and could be a potential commodity play for us. Baltic Dry Index down from 5,000 to 1,250. This is the cost to ship commodities between continents, and down 45% over the past year. Wheat futures down as well, 17% in the last 3 months. So our expectation is this core CPI is going to be falling quite rapidly. If we look at the history back when we had high inflation in the 70s and 80s, it could peak really high, but as soon as the inflation killed demand, you got the opposite. The inflation crashed and turned into deflation. So a big risk would be the Fed actually over tightening and putting us into a deflationary spiral. So we'll be careful for that as well. Michigan consumer sentiment, very low levels, typically a good time to buy stocks. And initial claims still being a little bit low. So we really want to see initial claims starting to grow, showing that the labor market's finally loosening up. We've got a really weird thing. We're not seeing a lot of job hires coming in, but we are seeing a lot of people quit jobs. So there's a small group that are running around between jobs trying to find the highest pay. So we're seeing some sort of counterintuitive moves in the jobs market still. Inverted yield curve still slightly inverted. That usually means peak interest rates are in, and it's a steepening of the yield curve that you want to be aware of. So if we look at this chart leading into the 2008 crash, this was going straight up, which means the front end is falling and the long end is rising. We're expecting the exact opposite of that to happen for quite some time. So a flattening of the yield curve. And this, again, will be very good for risk assets. that are long duration, betting that interest rates will fall. Okay, we're not long the dollar currently. We did do well with that last year. Actually expecting the dollar to fall. I would like the safe growth portfolio to have a dollar position in the near term. So we may add that back for the safe growth portfolio, a nest egg position. Here's the dollar index over the last several decades. What I want you to note is that as the government has grown its debt, even though we don't expect the dollar to lose its sovereignty in the currency markets, we are seeing it weakened over time. And what you can note is during each crisis, the high in the DXY has fallen. And it's about every 15 years, we're seeing a new problem in these markets. And the low is getting lower. So this next cycle could push the DXY index down into the 70s over a 15-year period. So if you're looking for something like BTC to hit 250,000 or even higher, that's exactly what you want to see in the trends. With China, the Middle East, and Russia, as well as India, and lots of South America starting to get off the dollar, this could very likely turn into a reality and be very good for digital assets over a 15-year time horizon. It'd be quite something to see this push to a new low. Here we're looking at the euro against the dollar, which it's fallen 10% in value against the dollar over the last 3 months. Here we have the yen, which has lost 7% of its value against the dollar in the last 3 months. Now in Japan, they are ramping up quantitative easing or printing money to buy their own bonds. They now own half of their entire bond market. And what they did is they let interest rates rise slightly to become more competitive. But they're now protecting that yield even harder with more and more money printing. Here's the yuan, down 3% against the dollar in the last 3 months. And here's the Russian ruble. Now, this is a little confusing. Now, this actually shows the Russian rubles appreciated against the dollar 19% over the last 3 months. But we're seeing that start to balance out as energy costs go down. The Russian economy won't be as strong relative to other currencies. Okay, stocks. Buy 8 shares of FNGU, 3-time tech giant play. This is quite likely going to new all-time highs over the next decade. It crashed from 400 down to 42 today. Just a massive, massive crash. But you're owning the big monopolistic tech companies that are shaping our future. So as long as we're right about the inflation coming down for at least the next 2.5 years into 2025, expect this to be one of the best performing stocks you get your hands on because it's leverage times 3 into companies that are really sold off like Apple, Amazon, and Tesla. Now we're looking at some general indexes. We have the S&P 500 over the last 3 months, looking like it's bottomed out, up 1%. We've got the NASDAQ down 6% over the last 3 months, but stabilizing. Emerging markets kicking some butt. In safe growth, you have triple exposure to this with EDC. Again, EEM times 3, up 7% in the last 3 months. This chart, we're looking at the market cycles of emerging markets against the US market. And you can see every other cycle, emerging markets has outperformed. And that's exactly what we're expecting in this coming cycles for the potential for emerging markets to dramatically outperform US markets. Now, right now, the tech companies are down so much in your safer bet. And we're seeing a lot of concerns with where China is going with how they want to run their economy to get too over leveraged over there. So we'll keep a close eye on that play and not be overexposed in any of our portfolios. The European market's kicking some butt, up 12.8% in the last 3 months. They were highly undervalued due to the war. And now that's starting to make some signs of positive outcomes due to their ability to store up the energy. But Russia is definitely getting ready for a massive offensive. So we may not see the end of volatility in Europe as we enter the next year. Another play we're interested in long-term is uranium. We're not in this play yet. We're just keeping a look at it, down 6% in the last 3 months. This one is the rare earth metals. Again, this is a hedge for your tech plays because they use the rare earth metals to create most of their products, down 15% in the last 3 months. This chart, we're looking at some of the leaders of the US stock market. Amazon down 29% in the last 3 months. We can see it's stabilizing and hopefully bottoming here. Apple down 13% in the last 3 months. Also looking like it's bottoming out. One of the plays that was previously in FNGU but has been removed is Alibaba. We now have exposure to that only with our EDC play, up 12% in the last 3 months. This company has been just crashing for 2 years straight and finally getting a good bid. Okay, very good. So if you're on a free trial and you want to upgrade, call Dean now at 505-322-7515. I'm going to jump into the track records and the risk calculator and look at some potential trades we see coming our way. And then we'll go into Q&A. Okay, our safe growth portfolio unfortunately had its worst return in its history in December, primarily due to bonds and Boyle crashing. We ended the year down 25%. We're in a leveraged portfolio ×3, and we had the same return as S&P 500, and we beat the NASDAQ. So all in all, I'm excited for the return we're about to deliver because we're going to make very few changes. We're already at 4% in January, and we're going to make back all those losses very quickly at the start of the year. And probably see a lot of that happen next Thursday when the CPI print comes out. The high-risk portfolio, which did a 233% return in 2021, was up as much as 50% in 2022. Also got hit hard on our Boyle and bond play in December. It's still down slightly because of the big Boyle play. But again, I see this ripping higher and greatly outperforming the safe growth portfolio. I'd really like to see the high-risk portfolio hit at least 100, perhaps 200% return for 2023. And I don't see us doing a whole lot of trades beyond where we're currently positioned. So let's break it down per portfolio and talk about what trades we see coming. Okay, here's the membership area. Again, if you're not paid, you don't have access to this. If you're on a free trial, you need to call Dean to upgrade. But you just punch in how much money you want to invest, and it tells you exactly what to buy. At some point, we're going to take some of the safe position in treasuries and reallocate into stocks, essentially. So that's a trade alert we're looking at. Also, NRGU is now looking attractive again. So perhaps we'll be swapping out the GBTC with NRGU and moving some of the TMF into either UPRO, EDC, or the triple Q. Most likely the triple Q at this point. On the high risk portfolio, we've already dramatically reduced treasuries. All I really see us doing is reallocating some capital into NRGU. I like our relative Boyle position. If that starts to jump up fast, which I know we're not expecting that after seeing it crash so hard, but let's say Boyle does start to run up really fast, I might start to pull off some of that and go into NRGU. I like our FNGU exposure at 22%. I like our coin exposure at 22%. TMF, I'd be okay dropping down to the 10 to 20% range and getting a little more of an energy hedge. Now, if the Fed does officially pause, I think we're going to see energy products rip higher, and that would be a good catalyst to get more bullish in those. Okay, great. I'm going to go ahead and jump into Q&A. Looking for any questions that are really relevant here that I haven't really answered in the presentation. Don is saying, is the repo number still a key? Yeah, I've stopped tracking the repo data as closely, Don, but I'll try to have more insight into that for your next update. Elliot says, do you think ETHE will? So ETHE is under SEC review, and the Digital Currency Group, DCG, is what's being attacked by Genesis. So it's just really unclear how that's going to work out. So that's why we got out of the way with the high risk portfolio. Safe Growth, I was waiting for the CPI next week to make one big adjustment to get us really set for the next quarter. Rock says, how do we play coin if we moved our Rebel's 10 times better than coin. Rebel is going to dramatically outperform coin. So you should replace coin with Rebel dividends. Much, much better play. Coin is going to be highly at risk of US regulators. Now, coin actually paid off the SEC $100 million. So people are speculating that the SEC is going to leave them alone for now. Their exchange volume is something like 1/30th that of Binance. So ETH is about to release the Shanghai upgrade in March, which means you can go in and out of staking. Right now, only 15% of ETH is staked. This could drive it up towards 50 to 75%, which is going to mean the supply is going to shrink. So I think we're about to see ETH really moon up to new highs. The Rebel dividends gives you that exposure with dramatic leverage. I'm planning to sell BOIL around March, probably mid to late March, almost irregardless of where the price is at. And that's due to when the supplies get really low historically in Europe. Now, if we see it skyrocket to really extreme prices before March, sure, we can sell it before. On the Elliot, are you talking about the ETHE battle? It's extremely confusing. It's very, very advanced financing issues that are going on. So unless you really understand things like Regulation M, all these different contracts, it's very, very hard to really understand what's going to be the outcome. It looks like what Barry Silbert's trying to do is wait long enough for Bitcoin to rally, because it makes the valuation of the digital currency group go up. And what he needs to do is borrow $1 billion to pay off Genesis loan. And he doesn't want to do it when his valuation will be at 90% less than where it was the last time he raised capital. So I think that's what he's trying to do, is just play off the creditors for as long as he can, and then get a better valuation, sell equity in the company, pay off that loan. Because he doesn't want to lose $300 million a year in revenue with their 2% fee at the current level on BTC. So yeah, just safer to be out of that one for now until there's more clarity on what exactly is happening. Yeah, so BOIL, we're going to hold into March and then sell it unless it skyrockets before. But in general, the fundamentals to go long BOIL and NRGU are going to be prominent for the next decade. So expect us to be playing those over and over and over again. And we hit 2 huge wins with BOIL so far. Our third attempt, obviously, we've had a pretty significant drawdown. But the reality is everything's going back to normal. The Fed's about to ease. Central banks are going to start easing, and demand's going to come back online. And the unfortunate fact is that due to this whole climate change agenda, we've put trillions of dollars into solar and windmills, and they don't generate enough energy. And still 80% of all energy is now still being used with oil and natural gas and coal. So that demand's not going away. So I expect us to see lots of opportunities to make money on BOIL and NRGU over the next decade as a critical hedge to being long tech stocks. Yeah, only thing we should be concerned about for energy is more lockdowns, which I don't think anyone's doing. China's reopening, it's going slower than we thought. And then we had this big heat wave. And we had Europe shut down its industries. They have to reopen the industries. And so, yeah, bad timing. We got unlucky on the third attempt. Remember, we made a lot of money on BOIL twice last year. The only thing that made money last year was betting on buying the dip on energy a handful of times. Everything else got creamed, or shorting the bond and stock market, but not with the VIX. You had to just do a direct inverse ETF. So people who made money in 2022 are pretty much this type of bearish people who miss out on the bull markets that are really the dominant theme over the last 40 years. So they may look good in 2022, but they're likely to greatly underperform as soon as things reverse. All right, guys. So we'll be back next week, the day before the CPI print. We'll most likely make some small adjustments to the safe growth next week ahead of the CPI, and then really be set for the next quarter, as I do believe the CPI was going to fall over these next 3 months, and the Fed's going to officially pause. And that's going to give us a big move in all these markets with how we're going to be positioned. And then we can get worried about if the move is too large, that the inflation impulse is going to become a problem once again. So hope everybody had a great New Year. I missed everybody, and we're back for weekly webinars until summer. So thank you guys so much.